my time, think it's my year, yeah.
Man, we got a good one today. What's up, everybody? Welcome to the morning show. I'm Spencer Israel. Joining me, as always, Steve Strazza and JC Parets. It is the first day of the month. You know what that means. We got some hot, fresh out of the oven monthly candles to discuss. We'll talk about that. We got some big earnings today. We got Salesforce, C3AI. What else do we have? We had Macy's, Nordstrom's, a lot going on in earnings land. Our guest today, Jeff Hirsch, editor of the Stock Traders Almanac, will join us in about a half hour. And then Sean McLaughlin from All Star Options will join us at 9:40. Also, Kimmy Sokoloff will join us every day as she does at 9:15. So let's go. Smash that thumbs up button if you're watching on YouTube. If you're watching somewhere else, go to YouTube, hit the like button. It's time for the morning show.
Hey, yo.
What's up, JC? Where are you from this morning?
Just in the office today. No big deal. Wearing ties, right? See that? Look at me. Come on, Strazza.
You look
Do I
good.
clean up?
I like the purple.
My daughter this morning apparently said, "Look, Mommy, Daddy's wearing purple because that's your favorite color."
I like purple. It's nice.
Yeah, I thought that was funny.
Good stuff. I'm glad to see you woke up and went to work today.
Somebody has to work around here, you know what I'm saying?
Yeah. All right.
All right. So as I mentioned, it's the first day of the month, which is, I think, your guys' favorite day of the month because it means you get to talk about monthly candles, and I imagine that's what we'll do in State of the Markets. So let's do it.
All right. Well, the first chart right away, I think, is worth mentioning. We'll get back to this one. Go to the next one, so that you could just kind of get started. Just to, at the end, one of the beautiful things about the end of the month is that it gives us an opportunity to take a step back, right? It forces us to identify the longer-term trends, the longer-term underlying trends. It's very easy to be like, oh, what happened yesterday? What did Dow do this week? What did the Yellen say? Whatever, the Fed, blah, blah, blah. Once a month, you take a step back and it's like, all right, in what direction are these prices going, right? Are they going down? Are they going up? Are they going sideways? We're seeing one-year highs in both the NASDAQ 100 and in the S&P 500, right? Highest close for the S&P since March of 2022. It is now June of 2023. And the S&P and the NASDAQ did that last month also. So it's not like it's anything new, really. So that's what's going on to the upside. To the downside, take a look at that small cap chart that we just had, that you could really see the Russell 2000 retesting those former highs from 2018. And longtime All-Star Charts readers remember the fourth quarter of 2018. There was a great opportunity to be selling stocks. These were the levels that we were selling the small cap Russell 2000. And ultimately, we broke out above there after COVID. And then we came back last summer and retested those former highs. So far, the buyers continue to show up. If we were to break that 169 level to the downside, we lose last summer's lows, then we can have a bigger conversation about, what it's pricing in. In the meantime, so far, it's absolutely held. Why don't you bring up the healthcare and technology? If you're wondering what's going to break the S&P 500 from, listen, it's making new one-year highs, new 14, 15-month highs, no question. NASDAQ 100 makes new 52-week highs every week, no question. But you can argue that the S&P 500 might not be in an uptrend. It might be like in a sideways trend, right? You can still argue that, like below 4,200 on the S&P, we're in futures right now. Futures are right around 4,200, so we're right there. What's going to break the S&P 500 out? I think looking at its largest weightings is probably one approach to see when the S&P 500 is going to break out. And healthcare represents 14% of the S&P. You could really see here it's been sideways for quite some time. And then technology now quickly approaching those former highs already, sitting above 26%. So, and by the way, this doesn't include Google or Tesla or Amazon or Meta. None of those are in the technology index. So those are in addition to. So those other four mega caps and healthcare and technology, you're talking about over half of the S&P 500 right there in and of itself. So if you're wondering when the S&P 500 is going to break out of this range, I think this is probably a pretty good place to look at these stocks. And finally, if you want to just throw chart 7 there, chart 7 is no, not that one. Save that for Sean. Chart 7. There you go. This is really what I'm looking at. The equally weighted commodities index peaked early last year. So even as the CRB index was making new highs into last summer, the equally weighted CRB was already rolling over. And ultimately, the energy dominant CRB index started to roll over as well, kept making new lows with the equally weighted commodities index. And now both of those commodities index are breaking down and making new lows. So the US 10-year yield ultimately peaked after commodities, right? So commodities moved first, then yields peaked. We've seen yields sort of coming down consistently since then. Are commodities breaking down to new lows, indicating that we should expect lower interest rates, number one? And if that is the case, is that why these mega cap growth stocks are dominating so much? Because they're also pricing in lower interest rates? So that's the question that I'm proposing. I don't know the answer, just to be clear, but the state of the markets is a way for me to sort of express like what's going on in my head. What am I thinking, right? Technical analysis doesn't give us all the answers, but it sure as hell goes a long way in helping us ask the right questions. And that's what we're doing, right? What are commodities and what is the sector rotation we've seen this year saying about interest rates? Strazza, feel free to chime in, but none of that says higher interest rates to me.
Listen, no matter what you look at these days, right? You make a great point. So interest rates steadily rising for the past few weeks, but what you're saying is the stocks or even just assets, commodities that do well when interest rates rise are actually making new lows. Then on the other side of that equation, we have the stocks that do well when interest rates fall or are supposed to do better when interest rates are falling or lower, making new highs and breaking out. So that's not jiving with the action in the bond market.
Yeah. So it's fascinating to watch. Yield curve, not to overthink the yield curve been rolling over recently as well.
What was your favorite monthly?
My favorite monthly candlestick, it's not so much favorite, but the one that I think is like most important continues to be small caps and XLF, right? The IWM and the XLF, sort of retesting those former highs. Like for me, like it's right there. That's what it is. Yeah. Industrials on a monthly basis don't look terrible either. So it's got that, but it's consolidating in a way where financials and small caps break down, that range in industrial is going to resolve lower too. Right.
So fun fact for you. May was a great month for tech stocks, right?
Indeed.
How many months this year, there are only 4 of them before May, were better than May for large cap tech XLK? This had to be the best month, right?
I would think, no?
Third best.
Wow.
We gained.
Well, January was a big one, right?
11.5% for XLK in January.
Yeah.
Another 10.5% in March. This is just 8.9% in May. So it's just doing what it's been doing.
It's just doing what it's been doing, right? Yeah, that's right.
Market's trend.
Yeah, Maria Bartiromo was asking me this morning. She's like, is it a problem that these biggest stocks are the leaders? And I'm like, I threw the old Todd Sohn quote. Your best players are scoring a lot of your points. Yeah, what's wrong with that?
And did she phrase it that way? That they're leading. It's not that it's only 5.
Well, she's like, she said she went with the 5 to 10, but I didn't bust her chops about that. I could have, but I took it easy on her. She was great. I love Maria.
I was on Twitter Space with somebody yesterday, and they were making that popular argument that's 5 to 10. And I said, listen, just look at the equal weight NASDAQ 100. It's up 25% from its lows, breaking out of this base, back above the August highs. And there are 100 stocks in there, not 5, not 10, but 100, all equally weighted. Mathematically, it can't be 5.
It's right, and it's not a breadth thing. It's a sector rotation thing. If growth is leading, of course the Nasdaq's going to outperform. Of course, the equally weighted indexes are going to underperform in the S&P that are more value oriented because you're equally weighting them and they're not cap distributed. So, like in the back half of last year, when everything was working except for growth, right? What was going on? Right? What was going on? The equally weighted indexes were all outperforming. I mean, that's what you're going to see when industrials are leading in energy and other areas that's not tech and growth. It's a sector rotation thing, not a breadth thing.
I totally agree with you. So yesterday, we did get a red candle, first time in a while, from a lot of these growthy things. But look at something like Avago. I'm only bringing that up because we did specifically mention it yesterday. Didn't get follow through, right? So we talked about that, the candlestick formation. We had one nasty candle, shooting star candle. You called the Empire State.
You like that?
Yeah, but no follow through, right?
No.
So void.
It's actually consolidating at a pretty logical area, right? So that was kind of my point. Like, let it dance, let it do its thing, let it reset up. That's a big base, you know.
So,
and by the way, for a lot of you guys that are wondering, like, why do you guys are always looking for smiley faces? Like, why are you guys? This is why. Like, you know, this is what we're looking for here, guys. You know, this is why we look for these basing patterns. And by the way, there's a million of them out there. And another good point that I think we should make is that not every market environment is going to be conducive for these sorts of patterns, right? It's not like, oh, I'm going to spend my whole career looking for this exact pattern. No, it's not necessarily how it works. In other cases, you're already looking for ongoing uptrends. But in this particular market environment where, you know, we've been in that bottoming process in a lot of stocks over the last year and a half or so, since the first half of 2022, when that bottoming process really got started in a lot of stocks, this one being no different, putting in that base. This is the environment where these types of trades are working. If we were in downtrending environments, these things would not be happening. If we were in longer, older, more mature uptrends in bull markets, this probably wouldn't be happening, right? These are the types of things that are happening in this environment, and that's what we're focused on. This is just exhibit A, but there's a million examples just like this, particularly in growth and in technology and software and things like that.
I mean, what you're saying is really no different from, you know, there are different tools that can be more or less effective based on the environment we're in, and that's the same is true for the chart patterns themselves.
All right, now, Spencer, what's moving this morning? Spencer, what do you got?
Cloud. We got our head in the clouds this morning.
We got some earnings here.
All right, what do you got?
Oh, what do I got?
Yeah,
what I got is not what I have, JC.
Let's start with the cloud stuff.
Like
Crowd and Salesforce.
Salesforce. That's where we're gonna start. Yep. All right. So here's the thing with Salesforce, right? It really wasn't that bad a report, right? The numbers were good. They beat the estimate on EPS. They beat the estimate on sales. Their guidance, which they reiterated, came in line as well. But there's the rub on the bottom of the screen there. It was their slowest quarterly revenue growth since 2010. So it was good. It just wasn't good enough.
So they beat.
They did.
But growth, came in. All right. So year-over-year basis. Let's take a look. Now, I remember when we were talking about how good this NVIDIA report was last week. There was a report from, I think, late 2020. I think Salesforce is on that list for most market cap in the day. I think they had like a 30% day late during the cycle in 2020, and it was a huge report. It's probably the last great earnings report before NVIDIA. Just throwing that out there. Fun fact.
You know, this is just another great example of these bottoming patterns that we were just exactly talking about. We keep seeing it again and again and again. This is no different. Salesforce has doubled off the lows, guys. Doubled this year, just to be clear. So this is a $220 billion market cap. It's down what pre-market? It's down 7% pre-market. You know, listen, this is almost doubled this year. We just entered June. This thing's already up 100%. This is a Dow component. Let's remember that they put in Salesforce right before tech stocks got destroyed. They put Salesforce in the Dow Jones Industrial Average, right? Kicking out Exxon right before energy exploded. Remember that? That was hilarious.
Sure do.
So this is an important stock. So I'm looking at like that 200 to 210 area. You know, there's good support there, I think. 200, 210. That's the level that I'm watching. 200, 210. Any weakness in there here pre-market, we're looking at 207. So we're right in there. You know, I think that this is probably a pretty decent place to accumulate if you're not in. If at any point Salesforce is below 200, I'd stay away. That's pretty good support for me.
So quarter over quarter, Spencer, I just pulled up the revenue trend here. So they just reported 8.2 billion in quarterly revenue. Is that what you're seeing?
8.25. Yep.
So last quarter, they reported about 8.3. This would be the first quarter that I have on record. Let me zoom out. I can go all the way back to 2003 here. This is really the first quarter over quarter basis that revenue did not grow. So that's probably why the stock is reacting the way it is. I just zoomed all the way out to 2004. This company every single quarter is making more money than the quarter before. And I'm not talking about year over year. So right now I'd be comparing it to
Sequentially, right. Okay.
Listen, this thing's almost doubled year to date. Let it dance.
Curious.
Let it dance.
Yeah,
let it dance. 200, 210. If it could stick this landing, I think it's fine. See how it closes. We start creeping below 200. Below 200, you can't own it.
All right.
Yeah, that's fair.
Let's talk C3 AI. And I apologize. I don't know exactly which one of the charts are in, but let's go AI next. This one was interesting,
Wow.
not for what they said, but for what they didn't say. So if you're looking at just the numbers, you would say, oh, this is okay, right? Their EPS came in above estimates. Their sales came in above estimates. Their guidance was okay, but they didn't raise the guidance. They didn't pull in NVIDIA and say, oh my goodness, AI is blowing the doors off our business. It's going to be amazing this year. They did not say that. They said it's going to be good, but they didn't raise their guidance in any way, shape, or form. In fact, the guidance may have been a little bit light.
Let stop. This is not even a real company. Okay, this company makes $60 million a quarter, compared to Salesforce's $8 billion.
Their ticker just happens to be AI.
Yep.
I was just saying off air. The problem with C3 AI is that their ticker is AI. I mean, just stop. What are you doing?
Remember when Ethan Allen kept going up in price when Ethereum was ripping and Ethan Allen was getting that sympathy bid?
Dude, this company is so small. All they've done is lose more and more money every quarter since they became a thing several years ago. There's nothing redeemable here. I don't know much about them. I'm not going to listen to the earnings report. They're just not material. They're just a company with a good ticker.
Well, they're down big this morning. So
0.
Yep.
No, I think this 30 level, I think this is a big one. We're pre-market, we're looking at 32. Kind of like the other one, if you're going to be buying this, I think this is where you want to accumulate. Like below 30, leave it alone. But if it starts to hold that 30 level, low 30s, that's where, that's that recheck. That's that pullback where if that's what it is, if this is a monster breakout and that's that recheck, I don't have a problem with that trade. You start creeping below 30, can't touch it. Same as the other one, right? Same as CRM.
Couldn't pay me to buy a stock like this.
Well, no one's ever going to pay you to buy a stock like this, so you don't have to worry about it.
If they would, I wouldn't do it.
Maybe the best thing and the worst thing about this is that their ticker is AI. It benefits them when, it benefits them.
Ethan Allen changed their ticker symbol so that they didn't have to deal with the Ethereum nonsense.
Right.
Isn't that hilarious?
All right, let's go to Chewy here next. I know Strazza has some thoughts here. Chewy's quarter was a good one. Their earnings per share came in well above estimates. They made 5 cents per share last quarter versus a 4-cent loss estimate. Revenue came in $2.78 billion above estimates as well. Stock is up today.
Slight positive reaction, right? A little less than 10%. I think I saw before we hopped on here. So, all right, Chewy is
stocks up 20%, by the way.
20% now.
20%, 35 bucks.
But yes.
Yeah. So it was a good report. We were on talking about it last night when the numbers came out. And I was saying, why isn't this thing up more? So that's interesting.
This is the cat food delivery thing that you use?
Yeah. So this is a $14 billion online.
You like it?
Let me talk. Yeah. Online pet retailer. It's great. It's a great brand. Anybody who has pets is probably aware of them. Most of us probably use them. It's like the Amazon for pets. I don't ever go to a pet store. We only have one here anyway.
How come you don't use Amazon?
No, better deals on here and
really?
They have everything. Like I order my cat's medicine directly from their website. You can't get that stuff on Amazon. But I like what they're doing. This was one of those like high flyers back during the COVID days. Listen, consistently growing revenue, consistently growing earnings lately, just finally turning positive on an EPS basis. This is no longer non-profitable tech. This is a real business. So I like this one. The base was shaping up. Do we have a chart? The base was shaping up nicely earlier this year and really kind of fell apart. There it is. Yeah. So now we're kind of like scooping and scoring back above those pivot lows.
Throw slide 2. I got a better chart.
JC, would you trade this back towards the upper bounds of the base?
My man, look at slide 2. I got you. I know where you're going. Give it to him, Spencer. Give it to him.
Yeah. Yep.
Right? Because these are the former highs from 2019. So, like, you have a lot of market memory near 35. Like, for me, it's 35. That's the level, right? Like, you could pivot off, and it did pivot off those former lows from 2022. It did do that. Great. But moving forward, I think that 35 is a big one. A lot of market memory there from the IPO. If we're above that, I think you could be long. Target up near 50. What is that? A 35% return? Nothing wrong with that.
And you know what? That's like an extra special polarity level because that is the IPO level, right? Right around mid to high 30s.
Yeah, people, a lot of times it's like, people anchor to the IPO. This is the IPO.
No, I like it. I think you trade that right back to those pivot highs. That
back to 50. Yeah, long above 35, target of 50, no doubt.
Yeah. All right.
All right, a couple more here. Let's look at CrowdStrike, which is down a little bit, down I think 10% this morning.
So you might see some sympathy selling in tech today. Some big tech reports, especially in like the cloud space between Salesforce and CrowdStrike, down, maybe drag on some of the indexes, at least the subsector indexes.
So this is a $38 billion company down 9% right now. CrowdStrike, CRWD.
Yep. And their report was, the headlines were beat, right? The EPS beat, the sales beat, the revenue guidance, the fiscal year EPS guidance was all in line, right? So the headline numbers were okay. I didn't look too deep into the report though, but it is down with the losers today are like are Okta, AI, some software.
So you are getting sympathy selling there.
Yep.
No, Okta had earnings too, I believe. Yes. How did they do?
Yes, I was gonna mention that next. So I think Okta may even be the reason why here. So Okta's earnings, the backward looking numbers, the earnings were okay, right? The EPS beat, the sales beat for last quarter. The forward looking guidance was a little bit light, right? Basically their numbers came in at the low end of the range that was expected. So like low end.
Okay. All right. Listen, the semiconductors really did well through earnings season. Software and internet did okay. Cloud seems a little weak. You know what I mean? Like results are mixed, even in the best sector, earnings wise. The mega caps did great. Semis did great, but then there's pockets of weakness.
Yeah, for me, you're looking at 153. 153 on the old CrowdStrike.
So I got to drop a chart. Why 153?
Well, pull up the next chart. Put up slide 2 there, Spencer. This is to me the level. All right. Yep, that's the level. 153. So here we are in CrowdStrike, right around 145. So we're below that. So we're in a range. Keep that in mind.
Let's look at one more here. Dropping in slide 1. What I've been doing on a lot of these charts, Alfonso knows we've been adding the 200-day moving average, like we discussed, because it is helpful.
Why? Because you got them curling.
Yeah, and you know what? We'll notice the ones where the 200-day hasn't quite had enough time to flatten and start curling. Those bases are more likely to fail because it's just a matter of time, right? They put in less time.
So what Strazza is sort of alluding to is that you've got these bottoming process, and we've been talking about these big bases that a lot of these stocks have been building over the last year and a half, really. And with that, these smoothing mechanisms, because let's remember what a moving average is. It's a smoothing mechanism. It's there to smooth out the underlying trend and the ups and downs in the market, and just smooth that out. A 200-day moving average does a good job from an intermediate to longer term time frame of sort of showing that transition from a downtrend and a bear market into an uptrend and a bull market, right? And the moving averages sort of show that. Just like when markets top, you sort of see the 200-day moving average building like a hill or building like a frowny face. It's the exact opposite, and we saw that, and now we've been seeing the opposite. And it's not the moving average. We don't necessarily need the moving average to tell us all these things. Like we could just go chart by chart and see them. The moving average just reiterates that. It's just another characteristic of those sorts of environments.
So when I see this kind of chart, let me tell you what comes to mind, the way I'm analyzing this in my head. Tell me if you agree or disagree with this, right? Here's what we've been saying about a lot of the bases. These are the bases we want to buy. I want 200-day flattened, curled higher. I want to have reclaimed those August highs. I want to see relative trend breaking out, and I want to see momentum overbought and not oversold, right? I think there's better names in that space. No, totally. But just hold on. When we look at a base like this, the August highs are too far away. So when do I consider this a completed reversal pattern? I want to see the trend line break that we have in blue here. That's not really a big deal, though. I want to see that 200-day flatten out and curl higher, which it hasn't done yet, right? And we're too far away from the August highs. So instead, I'm dropping an AVWAP, an anchored VWAP from the all-time highs, which is shown here in blue. And we're just there right now. I think if we can get maybe 2 out of these 3 things, the base is close to completing, but you really need that 200-day to curl up and turn positive.
Well, and you're seeing it more and more in different sectors and different stocks. So if you had to guess, when you look around and see what the others are doing, don't you think this is going to do the same thing? To my earlier point, I think it's one of the laggards. I think there's better names to be in software in general, and I think the market has proven that. I got one more before we bring in Jeff Hirsch. If you could just throw up slide 2 there. And I just want to show how just resilient this thing has been.
Real quick, in the chat, Ashley, momentum, is that the RSI, Steve? Yeah, when I talk about momentum overbought, I'm talking about the daily RSI 14 period. Sorry, Jason.
No, all good. No, I just wanted to end with this before we move on to Jeff Hirsch. You asked me before, what's one of my favorite monthly candles? I'm more biased to this one because we've been long. I think it's our best trade of the year. This one of the Tesla, but I think this might be the best trade of the year. 7 consecutive months Meta has been up since the U.S. 10-year yield peaked. The U.S. 10-year yield peaked, and Meta made a complete reversal to the upside. And when you think about the market capitalization increase of 150% just in the last 7 months, I guess I'm biased, but I think this is probably my favorite monthly candlestick chart. Pretty out of control, huh?
Dude, 1, 2, 3, 4,
7.
6. When we talk about the bases and the chart patterns we want to be buying, the ones that look like one another, and we see them over and over and over again, Meta didn't look like that. This one defied the rules that I just laid out, right? The 200-day did not have time to flatten and curl higher. This thing literally V-shaped bottomed, and that happens sometimes too, right?
It happens a lot of times. Not every bottom is the same. They're all different. I think this one is just the epitome of that change in interest rates.
You know what's funny, JC, when we talk about bottoms, right? Anybody who is not too familiar with market history going back beyond like 5 or 6 years, 2018 was just about a V. COVID was definitely a V, right? And those are the 2 most recent cycles we all think of. And then this year, classic bottom, really taking its time, carving out a nice base, taking forever, and driving people crazy.
Yeah.
You never know.
That's what the market does. It drives people crazy. That's literally its job. People are like, oh, the market's crazy, isn't it, JC? It's like, yeah. What else is new? Where you been?
Scare you out, it'll wear you out. Something like that.
Are we going to bring in our boy?
Mr. Hirsch. Did you read his email?
You want to do it?
No.
I didn't.
I remember. Well, I'll wait till Jeff comes on. Then I want to tell a story about last time I saw. Well, no, when I saw him late last year, last fall in Orlando.
I'll save some of the stories I have with Jeff Hirsch.
we have Jeff's note, and I'm sure he'll want to bring it up and talk about some charts. Jeff Hirsch, who's the editor-in-chief of the Stock Traders Almanac, the master of seasonality. Let's get him on the show.
Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Mr. Hirsch, the
What's
master
up,
of
fellas?
seasonality. I like that, Spencer.
I was hoping for master disaster like Apollo Creed, but you know.
Oops. Sorry.
Where's JC? We're kicking him out.
Yep.
Sorry,
There
my
he
fault.
is.
My fault.
Strazza says
So this is the first week of the show, guys?
This is week 2. Thanks for watching. No, I appreciate that.
Oh, last week you started. I was away.
Yeah. We wanted to have our homies in, as the first guests, so if we screwed anything up, it's all good,
All right.
So and listen, and we wanted to hit it hard from the start. Everyone's talking about selling May and go away. And if anybody has anything to say about seasonality, for those of you who don't know Jeff Hirsch, where you been? If you don't read the annual Stock Traders Almanac, like, do you even take your portfolio seriously? Like, what are you doing?
It's kind of perfect, right? We have Jeff on, not only in like a seasonal inflection point, right at the end of May, but we just got monthlies. We're in June. Jeff, when were we in Orlando together last year?
It was Halloween time, wasn't it? Late October?
It was late October, that's right. And we were talking, we had both turned bullish. You were talking about how you were long Dow diamonds, I remember specifically, and people thought we were kind of crazy.
Also the Qs and the Russells. Russells, having a rough patch with what's going on in the economy and the market and stuff. But we were long early. First, we were short last year. We were bearish through. We were looking for that. I mean, you guys were talking about history before I showed up here. It's one of those bottoms that just was sort of a rolling bear market, rolling bottom, kind of like 74, which was one of the analogs we were tracking all year last year, amongst a few others. And everyone kind of Russell bottomed. I know JC, you were all over that back in June with all the new lows stopping there, and then Dow bottomed September 30th. S&P on October 12th, if memory serves, and the NASDAQ and the NDX on December 28th, but all hit an intraday low in that October 13, it was an update, but there was a big candle there, since you're talking about candles today.
That was the CPI report that the market reacted the opposite way everybody thought it would react on, and you got the blowout Mariposa.
Remember,
Right.
I was on the phone with you, Strazza, and I was buying ARC pre-market on my phone. I was at Lowe's. I was like doing such dad things, like it was like a Wednesday morning or something like that, and I was like, we got to be buying this breakout. And I remember laughing about it with Steve.
I was talking about how much I loved the price action, and people were screaming at me on Twitter.
And then also by that point, even though the S&P and the Dow and the NASDAQ, hit new lows in October, there were barely any stocks left still going down. Most stocks had already bottomed, most of them in June, some even in April and May. Some had already bottomed by then. And then the big.
What do you think about breadth right now, though? I mean, that's one of the things
great.
we're looking at. It's a little bit, a little bad, a little crappy, a little stinky.
It's not that breadth. It's not that breadth is crappy. It's that concentrated leadership, in my opinion, doesn't necessarily mean widespread distribution.
No,
It's
it's not a bad
We're
thing.
not seeing any evidence that it is. And it's not like people are like, oh, why aren't we seeing any rotation? Why is it just this leadership? Last year, in the back half of last year, when all these stocks were going up, except these mega cap growth stocks, everyone was bitching that Apple and Tesla and these stocks weren't going up, and everyone was complaining about the market when meanwhile everything else was already working. And then we got that rotation into this year, and what happens? Everybody's bitching that those are the ones that are working. I mean, it's just, I think people just like to complain. I mean, this is what do they say, another brick on the wall of worry or whatever. I think that we need to see rotation, right? So why don't we get into the seasonality? Sell in May and go away, but in pre-election years and in years where the market gets off to a good start, June and July don't necessarily have to be bad months. It tends to get worse in August and September, right? Do I have that right?
Yeah, you do. Oh, there's my chart. That's the NASDAQ. I mean, it's sort of really a testament to the whole fallacy of sell in May and go away. We don't go away. We sell some things. We reposition.
We're not going nowhere, Jeff. Tell them we here. We're not going anywhere.
Yeah, I mean, I'm looking range bound. I mean, most of the time, the worst months, it's not just this shows the worst 4 months of for the Nasdaq. Nasdaq has a best 8, worst 4, worst versus Dow and S&P, which are best and worst 6. But it's really sideways action, and the thing that you look for in seasonality is the market tracking it in the current year, or is there some other forces at play? We see it tracking in the purple line here pretty well. Very well. It's been doing so since last year, and also along the 4-year cycle. There's that sweet spot we all keyed on of the 4-year cycle, the 3 quarters from midterm Q4 through pre-election year this year, Q2, which is ending here in June. Not as sweet as it has, historically been for Dow and S&P. Nasdaq's doing quite well, as we just mentioned, with the riding the AI craze or the tech wave there. But market's getting a little tired with the breadth we spoke about. Technicals, we're still having some trouble. Yeah, the NDX is at new highs, but Nasdaq was still struggling with the August highs. And it's just setting up with the geopolitical arena, with the technical arena, market internals, the seasonals. We still battling the Fed, and the GDP is looking okay, but not blowing any way. So
what are you talking about, Jeff? Who are you talking to right now? What you think that I care about your GDP projections? Come on, Jeff. You know who you're talking to. You know why I invited you here, and it's not because I care about your GDPs, right?
You want to talk seasonals?
I want to talk seasonals. Haven't I always told you that seasonals are part of technical analysis, right? Because
they are.
Back in the day, Jeff used to be like, well, you have your fundamentals, your technicals, and your seasonals. I'm like, bullshit. Seasonals are technical analysis, because what is technical analysis? It's the study of the behavior of the market and market participants. The study of the behavior of the market. Seasonality is part of how the market behaves.
I agree and disagree. We put seasonality in a slightly different category than fundamentals and technicals and monetary policy and sentiment.
Bullshit! But you're wrong. You're wrong. I will.
It's your show, man. I can be wrong.
All right, stop it. So, Jeff, in your note, so you came into the year bullish. Let's provide some context.
Still bullish.
Yeah,
still bullish.
But talk to me about this April 25th
MACD sell signal
for the Dow and
S&P. For the Dow and the S&P. We start looking to get out of the seasonals. A little bit early. The last month of the best 6 months is April, and we start looking for a technical trigger within the seasonal window using MACD. You can see the 12.26.9 down there. That's the sell side MACD. This is showing the Nasdaq, so this isn't really going to show the. I guess you can kind of see the April crossover. That was there.
Signal here though on the Nasdaq.
Say again.
You did not get a sell signal here on the Nasdaq.
Because Nasdaq has the best 8 months, which ends in June. So we start looking today. So if we get a crossover, pardon me, today, it will be a sell. It doesn't look very likely.
And we got a crossover in the Dow or S&P last month? Or in April?
Back in April. Last month was May. It's now June.
Yeah, it is now June 1st. All right.
So that's what we're looking for. And
so what, Jeff? S&P 500 5,000 this year?
No, not necessarily.
Are we gonna get a ripper into the end of the year, and it follows through into next year?
I think so. Maybe towards the end of the year, early next. I think we have.
Is that what you're saying, Jeff? Are you saying that you believe that the S&P 500 is going to hit 5,000 this year? Is that what you're saying?
No. I think
It sounded like you were saying that. It sounded like.
Did you run a poll on that? It was 6 to 12 months was the answer I picked. I think.
All right.
I think that was your Twitter poll. So not this year for sure,
but potentially.
Since you're throwing out big round numbers, let's talk about a big round number called Dow 38,820.
All right.
Have you seen that on a book cover?
Are we going to take a victory lap here? You can have it. We'll give you your flowers. You can have it. Tell the kids that they don't know. Tell the kids what you did.
The big question is what's next after that?
50.
No.
What do you know?
I'm thinking more like stock picking, seasonality trading market where we don't gain a whole lot of ground. Not next year. Once we get up to that 38,000, 40,000 Dow level and equivalent on the other indices, we might go into one of those, more similar markets to the 70s and 80s where there was a lot of action for traders, but not a whole lot of ground gain on the upside. maybe
Jeff,
another
you
sideways.
want to sell books? Just title it Dow 100,000, right?
Ah.
Make it $1 million, Dow to $1 million. You know, you want to sell books? That's how you sell books.
Hey, you couldn't go the other way and sell the fear, man. Dow 3,000.
You'll probably sell way more books.
Probably. Everyone likes to be afraid.
What do you think? What do you think people are? Sorry, Strazza, am I stealing and asking all the questions again? Am I doing that again?
It's what you do. Go for it.
I was going to ask, like, what you think, from a seasonal standpoint. Everybody's focused on selling May and go away. We're talking about the presidential cycle, the pre-election year, all of those things. What do you think, specifically from a seasonal standpoint, and it doesn't have to be stocks, it could be anything, that you think people are ignoring? Not being talked about enough, that you think is pretty critical right here.
Don't say GDP.
Yeah.
I mean, there's a lot of good, returns in bonds right now. I mean, this is we haven't had the ability to sit quietly in the summer and work on our next projects and be with the kids and play some golf and go away and hit the beach while we park money in bonds and earn some interest. So right now, which is part of our portfolio, our strategy, we've been switching into, and I just gave Pearl, I saw him on your show last week too. I just gave Pearl a couple of tickers that we have in our portfolio. Just, simple SGOV, SHV. It's just, the bond ETFs are sort of 0 to 3 months and the 6 month ones. That's just a place to, cash gives you time to think, man. And I don't see the market doing a whole lot. I think we could probably run a little bit further into June. On that seasonal chart you showed, I was highlighting the mid-July peak of the NASDAQ and the NDX, which sort of finishes with that little, what we call Christmas in July, that mid-year rally from the last few days of June to the 9th trading day of July. So, I mean, those are some, drilled down seasonal things. Also, the Memorial Day week's been negative recently. The week after Memorial Day, June 1st is got some positivity to it, but I think people are ignoring the fact that they could earn a little interest while we evaluate the where the market's gone so far.
Well, Jeff, you're seeing commodities just continuing to struggle. Looking today, oil not even getting a bid today. Copper a little bit. Oil not even getting a bid.
Yeah.
So continuing to point to lower interest rates from the commodities market, and then with the resiliency in growth stocks and technology. Again, also pointing to lower rates. To me, if from a seasonal perspective and an underweight standpoint, you think bonds are a good opportunity here. Seems to me like the commodities and the stock market agrees with you.
I would say so. I mean, seasonally, oil is and energy are over. Their seasonal bullish trend is over. It kind of ends around May. Starts more like December, February. So
that summer driving season bid in oil's bullshit.
No, it happens prior.
Right, because the market's smart.
In advance of it, so it's not bullshit. And we are putting out the Commodity Traders Almanac for 2024. That'll be out in the summer, late summer, early fall.
The more almanacs, the better, is what I always say. And then and everybody who's interested in this, first of all, read the annual almanac. If you don't, what are you even doing? Number one. Number two, the little book of season. What is it? Little book of
stock market cycles. Little book of stock market cycles.
Little book of stock market cycles. It's literally a little book, so you'll fly through it. But you break down so many different parts of seasonality and different things you can look at as an investor. Very quick read, very easy, and will help you use the annual Stock Traders Almanac better.
Thank you.
This is typically the part of the show where I turn around and reach to my bookshelf and show everybody our guest book. But I was actually reading Jeff's yesterday. It's downstairs in the living room. So
you only have one?
What? I was reading the one that I got last fall.
I got to give you another one for the office. You got to have one for...
Oh, no, it's downstairs. It's just downstairs.
All right. We're actually talking about redoing a little book, updating it. Go ahead, Steve.
You should. I really enjoyed it.
Listen, Jeff, before we let you go here, you got into the market at the right time late last year, and now you're getting out. How are you going to navigate getting back in come November?
Well, we use the seasonals and the tacticals together, and we will be looking for another MACD buy signal in October. In the meantime, we'll be, rotating into some of the, sectors that do well in the worst months. We might look for some shorts if something shows up on our stock screens, but defensive and cautious, looking for this, sideways, expecting some pullbacks over next month. So
technicals and seasonals. You're killing me, Smalls.
I'm going to keep saying it now.
So come November, you're looking for MACD crossovers to re-enter.
October, we start looking at October. You want to get that October volatility, that October phobia like we had last year. I mean, you can get in a little bit earlier. It depends what the market gives. You get a big sell-off or a correction in August, September. You can start nibbling. But
have you done any work on? And I know we only have like a handful of periods as a sample size, but have you done anything on debt ceiling and price history during these debt ceiling?
I mean, there's an analog chart in the slide deck I showed you of 2011. I've got some notations on. So it really sets up a lot like 11, which we had Democratic president, Democratic Senate, Republican House. McCarthy was, playing this from the same playbook as Boehner did.
Yeah.
But as I said, we saw that movie already. It's not going to be as much of a shock. I think we pretty much have a deal. I don't think it's going to have as much trouble getting through the Senate. Yeah, there it is. But the thing that is interesting on this chart, you see in July there, once the Budget Act passed back in 2011, market still sold off.
Yeah.
That's about 16-17% there. And there was a high of, this is the S&P on April 29th, and a sort of, Ned Davis research defined bear down 19.4%, bottom in October of 2011. So I don't expect it to pan out exactly like this, but geez, it's tracking quite closely with the 23 in the blue line there and 2011 in the black line. So another one of those analogs.
Just to be perfectly clear about this, everybody's worried now that there wasn't going to be a deal. I think I saw that there was a deal last night. I really don't quite care about it. But last time this happened over 10 years ago, the market was pretty resilient, pretty fine. Then they struck a deal. Then we got a bear market, basically right after it.
Kind of a sell in a news situation, I think. And also,
or just maybe, bear with me, maybe it didn't matter, right? And the market was more interested in other things. Because what people fail to realize is that people think that the market should care about the things that they think it should care about. But the market usually doesn't care what you think it should care about. And,
usually.
And by the way, European stocks had already been rolling over for a while before any of that happened in the United States. Now we're seeing the opposite. Europe is making new highs. This is a completely different market environment. Couldn't be more different. I think they're just taking old walls of worry bricks and recycling them. They ran out of things to scare people with. They're like, oh, let's do this debt ceiling thing again. It's ridiculous.
All right, we got to hop. Guys, we got to hop. Jeff Hirsch, editor-in-chief of the Stock Traders Almanac. Jeff, we'll have to have you back on again this summer and see how this plays out.
Thanks, guys. Appreciate it. A lot of fun.
Jeff, come out and play golf with me.
I will.
All right, let's do it. I play golf now, Strazza.
I'll show you.
I was supposed to play with Jeff in Vegas in April. We had it all planned out, and then I remember I had to cancel that trip. Anyway, some love from the chat. Just ordered the Little Book of Stock Market Cycles. Go Gyms, and Jeff drinks good coffee. So Jeff's awesome. He's a lot of fun. That was a great interview.
It's a great book. Easy read. You'll read in 2 seconds. Quick read.
I got to get that one. And then also, Jay Miller, this is funny. I've been looking for Spencer since he left that other show, and I find him with JC. Pumped. He resurfaced.
There he is.
I'm like a cockroach. You can't kill me. All right. Well,
listen, we're a fun crew. We like that Spencer's a part of us. No beef with anybody else. We love everybody, of course. But we're happy he's with us. We're happy he's on our team.
What's up, Jay? All right.
Everyone thinks it's funny in the chat, especially Rachel Finswit, that JC's pretending to play golf now. God forbid I'm better at anything than you.
Wait, we have Kimmy here.
You're not better than me. That would be an embarrassment.
Guys, we have Kimmy here, and she has to run. She has to hop in a second, so let's bring her on.
Kimmy.
Morning, guys.
What's up?
Where are you, JC?
I'm in your old stomping grounds.
Wait, where are you? Are you at a WeWork?
No, I'm in the city. I'm at our office. I'm at our office in the city. You have to come out here. Next time you're in the city, come over to the office.
Oh, okay. I'm
She's
flying
like,
up in and out. I'm flying
she's like,
in
I'm
and out
definitely not going to do
Saturday.
that. She's like, I'm going to be at the bar with my girlfriends and going on runs and, the old stomping grounds. When are you coming back to the city, by the way?
I'm out just Saturday for the day, flying in and out. My younger brother had a baby, so.
Oh, nice. Well, congratulations.
Thank you.
You're going to be in Long Island.
No, in the city. He's in the city. My
All
younger
right,
brother.
all right. So market is S&Ps are flat, Nasdaq's flat, Dow's down a little bit. Are we taking both sides here? We're looking for longs and shorts, or you're leaning in one direction?
Well, I'm looking at a couple names. I'm watching Tesla around 200 again. It keeps struggling, so I'm going to see if it could actually push through maybe to 205 to 207.
Yeah.
I'm looking at CVX. Chevron had, I think, a little upgrade today. I'm seeing how it handles this level in here for potential bounce.
Yep.
CVNA, Carvana, nearing the 200 day, around 1390. We'll see how it handles that. UNH in the morning note, looking here, it keeps struggling under 489. Right? Is it 489 that level?
Yep.
Let me see. 489, maybe for a pop to 495. We'll see. That's all I got.
I like where your head is at, Kimmy, with respects to some of this rotation. These healthcare names, you're talking about UNH, you're talking about Chevron, down near support, potential support anyway. If they are going to bounce, these are some pretty logical levels. These things have been beat up pretty bad, while other areas of the market, like, the technology and those growth areas. So I like where your head at with some of these mean reversion in some of these areas. I'm totally with you on that. Love that.
Good. I mean, even look at Target, all that. I mean, busted. Holy cow. Look at that.
Carvana, what's the short interest? Anybody got the short interest handy in Carvana? I got 70% of the float is short. Is that right? That's a lot.
That's probably in the ballpark.
Wow.
No. 50.
What is it?
50.
50% of the float, and then
50, 70.
And then right, exactly. At this point, what the hell's the difference? And then what's the short ratio? Oh, the short ratio is 2.5 days, so it's not that obnoxious.
About 3 days.
Right.
And that figure is going to vary depending on where you get it from because of the average volume.
True. Wow. Listen, Kimmy, I love where your head is at in this one. What about the indexes? Staying a little neutral, or you think they go higher?
A little neutral. I think, yesterday the debt deals, it was buy the rumor, sell the news yesterday. Today, we'll see how it handles. It's like this 416 level on that SPYs. It held it yesterday nicely. So we'll see how it continues to hold in here, if it fills out or not. I think we're just in a little in-between spot here. Nice pop last week, consolidating. We'll see if it's consolidating, go higher or lower,
Kimmy, there's a quick question in the chat for you. Can you talk XOM and its correlation to crude?
XOM. Sure. Let's see. Where is it trading at? Where is it indicating this morning? Let me see on my list. 102, down a little bit. I'm looking to see, if it could hang on to roughly this like 101 level. Okay. We want it roughly the 101 level. Potential pop up to 104.80.
All right, guys.
I got something to add to that quickly. To me, what's really impressive between that correlation, asked specifically about ExxonMobil and crude oil, is really the resiliency that we've seen in ExxonMobil and other energy stocks as well, despite the 40-something% correction in crude oil. So if anything, when you look at that correlation, I'm impressed. When you zoom out, right? Not like yesterday or today. When you zoom out, bigger picture, that monster correction over the last year in crude oil has come with energy stocks going mostly sideways.
Yes. And then, but typically, I think oil, is shaky around now, some midsummer, and then starts getting going. Typically, we have to ask the Almanac trader that. He knows that stuff.
Yep.
All right, Kimmy, have a great rest of your day, guys. Kimmy Sokoloff runs a live trading room every single day where she is live trading the market open and announcing her trades. If you want to get into Kimmy's room, I will have a landing page, a place for you to go soon. But in the meantime, the best thing for you to do is just to email us at the email address on the screen, questions@stockmarketmedia.com. You can also call us. Our number is functioning. Isn't that true, JC?
Oh, I haven't tested it, but I believe you.
You know what? I also haven't tested it. Maybe I should test it before I give the number out. I'll do that. I'll test it before I give the number out just to make sure that it works. But I was told that it works. Anyway, use that email address on the screen. Email us, and we can talk about how to get into Kimmy's room. Okay, it is 9:25, 5 minutes until the open here. And we're gonna have Sean McLaughlin on in a couple of minutes. You want to talk chart report?
Hell yeah.
Okay, let's get the chart report up on the screen and do that. All right, I've got yesterday's edition of the chart report up here on my screen. This is the chart of the day from one Jake Wujastic, kind of echoing what you guys were discussing in the state of the market segment, right?
Yeah, I like the I like the bespoke invest chart, talking about how tech is only 5.8% from its prior bull market high, right? And it was down 34.3% at the low last year. You know, in terms of like how close it is to making a new high. That was an interesting stat. I kind of figured, but I hadn't run the numbers yet. But yeah, that's real interesting.
All right, guys, the chart report is a totally, completely free daily note compiling the best charts and trading wisdom from around the world of finance. If you want to get the chart report, it is super easy to do. All you need to do is go into the description of this video on YouTube where it says the chart report. You can click on that link. You can also scan the QR code on the screen right now. It says it right there. Oh, that's the wrong one. That's the right one. Chart report. Scan that code.
Can you throw the Jury and Timmer chart quickly? Since I'm not going to be on tomorrow's show.
Which one?
Don't be sad, guys, that I won't be on tomorrow's show. Maybe I'll be able to call in for a minute. Go to Jury and Timmer. Keep going. The Bitcoin Renaissance.
Okay.
There it is. Yep, that one. To me, this is just really interesting. I love the fact that he went to the highs and sort of marked out what the different patterns have been in the past, giving you different options. I thought that was really cool because how many times, Strazza, have we compared the current environment to other prior consolidations throughout the history of Bitcoin, but we hadn't sort of taken how those progressed afterwards, like Jury and Timmer did here. So I thought this was really cool.
This is a cool new perspective for me because we're used to zooming out on this chart and pointing out, mostly the fact that it doesn't violate its prior cycle highs during bear market periods. He's telling us, where it could go now after holding that key level from 2017.
Yeah, I think it's really, really great chart, which is another great aspect of the chart report is that, I don't have time to be playing around on Twitter all day. I don't talk to Jury and Timmer. I mean, I've met him, really nice guy, super smart, does great work. But it's not like he's texting me charts, right? So it's a great opportunity for me to, see some of the work that he's doing. I'm not surprised. He does amazing work. He has for many, many, many years. So I'm not surprised that I like one of his charts, right? I tend to.
Yeah.
All right.
Good.
There's the code on the screen. Scan it. Get the chart report. It's free. 9:28. We're going to open here in about a minute and change. There was a couple of earnings we can talk about, smaller, ones that don't matter, like Macy's and Nordstrom, or we can go to some ratings that we had. Or I know Steve had some uranium charts he wanted to discuss. So I'll go wherever you guys want to go.
Let's start with some of these headlines, right? So Salesforce, even though it's lower today, slight boost to its price targets across the board from like 6 or 7 different sell side shops.
Yeah.
See, what the hell is Citigroup doing over here? What is this? Am I reading this right?
This is ridiculous. They upgraded it from a $129 target to a $130 target.
No, they maintained it at neutral,
but changed the target by $1.
Hiked the target from 229 to 230. I hope I got that news wrong or that's incorrect. Please let me know if that's the case. But I don't think so. I think that's real news this morning. So
I feel like if I were that guy, I would do it just to mess with just the whole system. Be like, what would make me to really stick it to how terrible this system is? I'm going to maintain it neutral. I'm going to raise it by $1 just to be an asshole. Right. You know what I mean? Like just for shits and giggles so that I can tell my buddies over the weekend, you should have seen the shit I did at work this week.
I have to question if a human's even doing that because it's so bad. Like, is that a computer? Is that some sort of like, is that automated?
I'm going to give the benefit of the doubt to the analyst and say that he's just being funny and he's just making himself laugh. I feel like this is something I would do. Like if I were a sell side analyst, I am not, fortunately, but if I was, I would need a way to make myself laugh, and that would be one of them. That would be one way.
All right.
Like for example, Google back in the day, they used to report their earnings the night before options expiration every quarter, and I was always convinced that they would do that just to mess with traders. Like be like, you crazy bastards, we're just gonna mess with you guys. Like I'm convinced to this day that that's what they used to do.
Probably right. All right, I'm going to read some more silly headlines from this morning, or just notable headlines. Give me your take. Layoffs jump in May on tech, retail, auto. Year-to-date hiring lowest since 2016. Are you worried about it?
There's nothing I could do about whether people want to hire people or not. You know, we're hiring. If you need a job, right? We're hiring.
We're always hiring. Yeah. All right. Okay, so nothing there. These lists always get me. So Goldman just came out with a new conviction investment list. And if you ever look at these things, I'm trying to get my hands on it. Might be in my inbox now. It includes Apple, Amazon, JP Morgan. I don't need a sell side analyst to come and tell me that the best stocks are the best stocks. Okay.
Yeah, but what's wrong? Oh, hold on. But this is Goldman Sachs. And then you and I who love a good list of stocks to go through, a list of stocks that, you know, maybe they're insider buying, or maybe they're seeing unusual options activity, or maybe there's always, they're increasing their dividends every year, right? Like there's interesting. Wouldn't you put the Goldman Sachs conviction buy list as an interesting pond to go fishing in?
Yeah, but honestly, I mean, listen, I'm going to get my hands on this list. Typically, it's like the NASDAQ 100 or Mega Cap Growth Index. They're not. Listen, all I'm saying is,
if you get one idea from that list, it's not worth it.
I don't know if I will. I don't know if there will be a single mid cap in it. All I'm saying
such a negative Nance. I promise you, if I look at that list, I will find a stock that I perhaps didn't notice was doing something interesting. I bet you. And if not, then I'll be like, it's a useless list. Right. I don't think it's a useless list.
I'm going to look through the list. Innocent until proven guilty. We'll look through the list. I'll come back tomorrow and we'll talk about it. All I'm saying is, like, provide a little value for me here. Give me a mid-cap stock with some, like, cool growth story.
You don't think they have mid-caps on their list?
Dude, it's Apple, Amazon, Nvidia, Microsoft. Like, that's not helping me or anybody, really.
Well, who are their clients, right? Are their clients, bottom fishing in some crappy small caps? Or are their clients
trying to track the benchmarks? And that's what this is.
Yeah. So just, when you're thinking about, someone's opinion, whether it's JC's or Strazza's or a sell-side analyst or an economist, just understand who they're catering to. What's their job? Like, what is it that they're trying to accomplish, right? So for us, we can very easily, we do buy small caps and mid caps, and that we don't need to stick with these mega cap names. But if you and I had $1 trillion in assets under management, then we probably need to stick to some of those bigger names, right? We don't have a choice. So let's just remember that.
But then don't say this. The Conviction Director's Cut List is designed to provide investors with a curated and active list of 20 to 25 of what we believe to be our most differentiated fundamental buy ideas.
AI definitely wrote that for them.
Apple, Amazon, Nvidia. What does differentiated mean in that sentence? Let's move on.
Wait,
is hating on Goldman Sachs?
Is AI the next great sell-side analyst? We'll find out. Okay, there was a couple more
Can't
ratings.
Get any worse.
I hope so.
There was a couple more, actually, just to finish this off here. JP Morgan upgraded Domino's Pizza to buy today. I hadn't talked about that stock in a while, so I believe we have a chart here. Let's get it up on the screen. Wanted to share that quickly.
So it looks like the opposite of a lot of these restaurant stocks, right? When you look at Chipotle and what McDonald's has been doing, and Yum Brands and Wendy's, all these stocks, Wingstop pushing up against new highs. Domino's Pizza, maybe the shareholders are finally realizing just how bad this pizza is. It is unedible, Strazza. Unedible. And I'm a little bit bougie when it comes to my pizza, fine, but it's really, really bad. Bad.
Here's the problem. I never understood the price action in this stock. It was a stock I never would have touched when I lived up in Connecticut and New York, because it's just not something we do up there. We don't eat Domino's. after living in Florida for a while and living down south, it's different down here. And like we talked about with Josh and Batnick, there is a time and a place for Domino's Pizza.
You are disgusted. I am disgusted with you.
This is a secular leader for most of my career.
I couldn't agree more with Strazza's pizza take. Once you move away from the pizza belt, you don't understand how bad the pizza is. You know,
I lived in California for 5 years. Trust me.
I remember in college we used to go visit like my friends at Clemson. All they ate at night was Domino's Pizza. There were no other options, man.
Yeah.
Like it's.
But I'll tell you what, Spencer. As bad as the pizza is in California, the tacos on the East Coast are way worse than the pizza is on the West Coast.
That may be. And then the next one I wanted to add here was RBC is making an interesting call today. They're upgrading Chevron to outperform, and they're downgrading ExxonMobil to their version of neutral, sector perform.
Can I complain more about the sell side? Spencer,
no. The only reason I bring this up is because it's good fodder for us, and I thought maybe you might want to talk about
I like the dip in Chevron here. I don't hate this dip in Chevron. Kimmy was looking at it. Uncle Warren likes it, right? I don't hate this trade. If you're going to get any kind of rotation into energy, Chevron obviously is going to catch a bid, and you got a tight risk reward against the March lows. Like that's the trade. If you want to be long Chevron, you could be long against those March lows. I was looking for a breakout above 187. I've been waiting patiently. I thought it would happen sooner. It hasn't happened, which is fine. I don't care. Let it go to zero. It's not my problem. But on a trade right here, right now, I don't hate it. I'm with Kimmy. Long against 150. What do you think, Strazza? Are we getting cute, or do you like this trade?
I'm marking up a chart right now. My problem with this is simply the stocks are going to go in the same direction. So one of these calls will be right, and the other one will be wrong. Right? Like Chevron and Exxon aren't going to move in opposite directions. You shouldn't be bullish one and bearish the other. Yeah. I just overlaid the two on the chart. I'm going to put it on slide 1. Do I have the right deck here? Yeah. Throw this up. Like this is the issue with this. Like tough pairs trade because they're so correlated. This is Chevron and Exxon.
Yeah. If you're long one, short the other, I mean, like
Yeah,
I mean, maybe if you're a market neutral kind of, listen, there's a time and a place for everything. What do you like better? So Uncle Warren's he owns a ton of Chevron. He owns a ton of Oxy. Which one do you like better?
I mean, I don't like either right now.
So you don't think that this is overblown, the sell-off in energy and commodities? You don't think it's overblown? This is a trend. It's going lower. Interest rates are about to collapse. The world as we know it is coming to an end. Is that what you're saying?
I'm with you that we should err on the side of getting that rotation. But we got to see it. Not seeing it. And if you ask me between Chevron and Oxy, like if I had to pick one of the two, since late 2020, Chevron has been moving in a straight line lower relative to Oxy. So yeah, I guess Oxy, but both are vulnerable here in my opinion.
Bring in Shawnee. I want to talk about this trade. I really like this trade a lot. I wasn't convinced at first, but it got me. It got me.
All right, it's Thursdays. On Thursdays, we talk to Sean McLaughlin. It's time for options with Sean. Let's bring him on.
Shawnee, baby.
We're here with our resident debt ceiling expert. Sean, do you have an update on the debt ceiling from last night?
You don't want my hot take because I don't have one. I don't pay attention to that stuff. All I care is what the market does, and the market did nothing. So it's a nothing burger. Great.
Game 1 tonight, Sean. Game 1, right? NBA Finals. Let's go. Miami against Denver. Sean versus JC. Who's going to come out victorious, Strazza?
I'm such a bandwagon fan of the Nuggets. It's great.
Sean is feeling the Nuggets right now. Sean is loving his NBA right now.
I don't think nobody even knows where the Nuggets even play. Like, people are like, what are the Nuggets?
I've lived here for 11 years, and I have not watched a single game until this playoff.
Well, they're actually really, really good. Okay, so before basketball starts, we can put some trades on, right? We can make some money to help pay for that Bordeaux that we'll be drinking later. What?
Well, hey, let me start off here real quick. I know how on the beginning of the month, JC gets all giddy like a schoolgirl because of the monthly candles. Well, I'm not as extreme as JC, but similarly, when we get to the first of the month, that's a big day for me as an options trader because I like to look through my portfolio and look at positions that I have on that are now into the expiration month. Positions I've had for 5-6 months, and now we're starting to get to expiration. It's time to act. So if you guys have that chart of Toll Brothers, I want to bring this up. This is a trade we've been in for a while. We got into Toll Brothers. Let me look at my spreadsheet here if we get the exact date.
Relative strength in these home builders. I was told the consumer's dead and can't afford anything, Strazza.
Right. We got into this trade back in January. We bought June 65 calls. And as is our best practice when we just do a simple long call trade, I always like to sell half of my position when I've doubled my initial investment, which we did that. We had an opportunity to do that back on May 18th, not too long ago. Well, now here we are. It's June 1st. These options are going to expire soon. We got about 3 weeks. And so now I get this question all the time, like when do I choose my exit? So what I do now is I see that my calls are in the money. So Toll Brothers is trading at about $68 right now. My calls are the 65 strikes. So what I do is I'm going to trail a stop loss level in the stock price below a 3 to 5 day low. I use a little discretion. It's not perfect science here, but I want to just kind of trail my stop loss, below the latest 3 to 5 day low. So in this case with Toll Brothers, it's kind of hard to see on this chart that we've got here, but the 3 to 5 day low was yesterday. It was at 67, something like that. So if we break that level intraday, anytime during the day, then I will go ahead and exit my calls. I don't leave a working stop loss level in my calls. This is a question I get a lot. Also, like, do you put a stop loss order in your calls? No, absolutely not. Don't do that. The options market is not that efficient. You're going to get a very bad fill if you put a stop loss order in options. I just wait for the stock to break my level, and then I go into the market, take my time, work my order, work my exit. But that's what we'll be doing on Toll Brothers from now for the next 3 weeks. We'll be, ticking our stop loss, hopefully ticking our stop loss level up and watching for a good exit. But that's my best practice. That's what gets me excited when we turn the calendar into a new month.
No, if you look at it like really, really short term, if we were to zoom way in on Toll and overlay ITB or XHB, really resilient. Like there was weakness at the industry index level, but Toll is holding up far better than its peers. Okay.
Yeah, it's been one of our big winners this year. I know JC likes to talk about the Meta trade, which Meta has been a big winner. I, as the options trader, I'm already out. I know JC's still in. My position, we had May options.
John got shaken out on that trailing stop.
No.
No, isn't that what happened?
I wouldn't call it shaken out. It's just we had May options. We had the
I'm in the Junes.
Yeah, no, we got out in May.
Right.
Great trade. I mean, one of our best trades of the year. And this Toll Brothers one has the potential, if we keep going higher for the next few weeks, it'll rival Meta for sure.
Yeah. I think we're just looking for Meta to like finish filling the gap here. I think our target for the common is around 290. And look, with these mega caps here, and I know Toll Brothers and the home builders are trading like mega cap growth stocks this year, but you just want to keep riding them. Like Google, target one was hit, and now it's just high and tight and flagging. Like you could just keep putting these trades back on, and kind of.
I mean, are interest rates going to collapse, dude? Because that's what these charts keep. I know Sean. Whenever Strazza and I start talking about interest rates, Sean's like, "Here we go with their bond market."
See you later.
No, Sean, can we get into the trade from yesterday? I really want to talk about this because I really like the risk versus reward. I really, really, really like the risk versus reward. I think it's really interesting how we're able to own such a volatile stock that can move so aggressively. It's got a beta of 5. That means it moves 5 times the on a daily basis than what the S&P 500 would move. And it's got a decent short interest too, Marathon, right, Strazza?
Yeah, like 40%.
Wow.
30 or 40.
Listen, enough where it matters. You're getting exposure to the crypto markets. Interest rates rolling over, that theoretically should be bullish. I really like the risk versus reward here a lot, Sean. I like the fact that we were just able to buy the calls, go out as far as we could.
Yeah, the calls were not overly.
Throw the merit chart up.
This thing is
the calls
tight,
are not.
man.
Yeah, it's tight. It's coiling. It feels like it wants to pop. I mean, we talked about it yesterday. On the one hand, the stock has already rallied, 300% year to date. But look, this is Bitcoin. The numbers are different, or cryptocurrency space, right? The numbers are different, right? And the high from, was it 2021? The high of this chart of this stock was somewhere in the 71 area. Oh, there you go. I got the chart up there. 71. I mean,
80.
This thing could. I'm not going to sit here and say that I'm positioning in this stock because I think it's going to go to 71 over the next 6 months. It can, and it wouldn't surprise me at all. We've seen some crazy moves in this space, but really, if we could just retake the prior year highs up above 20, which is much more realistic, we're looking at a 5-bagger in this trade, right? Because we bought the 14 straight calls in January. We paid $1.85 for them. So let's just say we paid $2, right? Let's just keep the math simple. If this thing goes to $20 and beyond, the calls are going to be worth at least $6, probably more. So
probably a lot more, especially if it does it soon, right?
If it does it soon, it'll be worth a lot more. So, I like this trade because it's simple, right? We just bought calls. We know what our risk is. If this thing doesn't work, we lost $1.85, which is what we paid. And I didn't go and buy, 5,000 contracts. I bought an appropriate amount for my account so that if I lost everything, it's just like any other loss in my portfolio. That's the way I do it. That's how I sleep at night. But if it does rip above 20, and if, long shot, if it does make a run at those previous all-time highs, this trade will have a very meaningful positive impact on my portfolio.
Ken makes up a good point. Riot also. Riot looks a lot like Marathon, so that's actually a great call there, Ken. They're coiling together. Might even look better, Strazza said. They're likely to move together. Another point that I want to make, that Sean is talking about how, he's keeping our lives simple. We're just buying naked calls, not a big deal.
Love it.
There's a time and a place for everything. We can't do that in every type of market environment, right? A more volatile, where the VIX is in a market where the VIX isn't at new 52-week lows every week, we're getting more volatility. You're not going to be able to do that, or it would be much less advantageous to do that because it would be so costly to, quote unquote, keep it simple and just buy calls. You would most likely need to finance that trade by selling a further out of the money call, or perhaps an out of the money put to help pay for that. There are other ways to take advantage of those particular types of environments. But in this unique case, I mean, it's not that unique, it happens, right? Where volatility is muted. You could just, like Sean said, just keep it simple and go out as long as you can with your call options. You've got built-in risk management already in place, right? I really, really, really like that a lot. And taking advantage that those are the opportunities that we have in this environment that in future environments we won't.
Yeah, I talk to new traders all the time, and they questions I get all the time is, options are so complicated. All the deltas and the gammas and all these Greeks, and I'm like, yeah, options can be complicated, and there are certainly professional traders out there who do very complicated strategies. Skew plays and all kinds of arbitrages. And look, that's great, but you don't need to make it complicated to make money with options. In fact, my default move all the time, you guys know this, is I like to keep it as simple as possible. Yeah, sometimes I put on complicated trades if the environment makes sense for it, but I will, given two options, a simple one or a complicated one, and they both are viable trades, I'll go with the simple one every time because it just makes my life simpler.
Sean, there was a question in the chat from Fred.
And Fred, too, we talked all about this yesterday or the day before on the Flow show. Sean was talking about how he executes and what kind of orders he uses, but I thought this was a great question.
Okay, so I see you, Fred. Do not use preset stop limit option trades. Okay, so Fred brings up a good point. If you're worried about getting a bad fill on an options trade by putting a market order in, the next logical thought is, oh, well, why don't I put a stop limit in? So at least I could define my price. Yes, that will define the price that you will get out, but it's kind of a false sense of security, because if the market moves and it moves wide on you, if the bid-ask spread widens out, market makers probably aren't going to fill your stop loss order, even at your price. You can't just walk away and think, oh, I got a stop loss, I'm going to be fine. No. You still got to pay attention. I don't like any kind of stop loss orders in options. I just like to work my orders manually. If I find myself in a situation where I'm trying to get out and the bid-ask spread is wide, what I will do is I will put a limit order out approximately at the mid price. So let's say an option is bid 50 cents, offered $1, which is not uncommon, by the way. It's a wide spread. If it's bid 50, offered $1, I'll put a limit order at 75 cents. Yeah. Often I'll get filled pretty quickly. But if I don't get filled, I'll start at 75 cents and then I'll start taking my offer.
Yeah, but Sean, don't forget about the resting orders that we place. So like, for example, if we buy this in this particular instance, we bought the call options for a marathon, $1.85. So at $3.70, is that right? Yeah, $3.70, we have a resting order to sell half that position. We're entering that now. As soon as we buy it, we enter the resting order to take half off the table as soon as it doubles. And, we're not paying attention. I'm in a meeting, I'm doing something, and then boom, it'll just get triggered and it'll get executed. And it would be a trade that I entered a couple of weeks ago. So there's that also, Sean.
You're leaving a limit order then.
I'm leaving a what?
We do that.
A limit order.
We do that, JC. Yes, we do that. You are correct. But what Fred is asking is about when I'm trying to get out of a trade that's not working. All right.
Downside.
I absolutely, as JC said, when I have a profit target or I want to sell half at an advantageous price to me, yes, I leave that limit order out there. I leave it good till canceled, and I don't pay attention to it. The market will take me out, and that's great. But as far as getting out of a trade that I'm losing on, where it's not going my way, that's a trade that once that stop loss or once that price level in the stock is hit, then I start manually working the order. I don't want to just throw market orders out there in the options market. It's a bad idea.
When you say manually working at it, ideally you're looking at like the market depth. You're seeing what those contracts are actually being traded at, and you're trying to work your way in, right? Somewhere between the bid and ask.
I wouldn't go that far. I'm just looking at the bid-ask spread. I'm just looking, what's the bid, what's the ask, and can I put a limit order out there somewhere in the middle? And if I don't get filled right away, then I'll just start lowering my price, penny or a nickel at a time, depending on the price.
And Sean, while we're on the topic, talk to us real quick about how are you managing in terms of like the price action that you're watching to get in or out? Are you looking at the underlying, or are you looking at the options contract itself?
The most important price to me is the price of the underlying. As far as getting out, right? I mean, getting in and getting out are two different things. When I'm getting out, my cue is on the price of the underlying. Once that price is below my level, or through my trigger point, then I just start working my exit on the options. All right. When we're getting in, I'm a lot more patient, right? Like I don't have to trade. No one's got a gun to my head saying you have to trade. So I take my time. I work my order. I don't need to get filled right away. I'll put my limit order in at a fair price, and I'll let it sit for 5-10 minutes. If it doesn't get filled, then I might improve my price if it feels right. But I definitely take much more time getting in than I do getting out.
JC, you're on mute.
Can we leave Sean here for recess, Spencer?
I mean, you can ask Sean. Sean, you want to hang out?
Would you like to stay for a few minutes? Hang out with us?
Well, you guys are so kind. All right, I'll hang out.
The only thing I want to add before we get to recess is that whole Mara trade, Mara, whatever you want to call it, that was they were talking about. You can get alerted to that trade before these guys talk about it on this show. Okay, that trade got sent out as an email. Sean's email that he sends out. So I just put the QR code on the screen there. If you want to scan that code, or there's a link in the description on YouTube that subscribing to that email, that Options Ideas email, you'll get notified when these trades happen. And you can hear about them before JC and Sean talk about them on this show on Thursday mornings.
Before Sean comes on YouTube and starts moving markets, you
right.
Want that alert.
Big time. Sean's big time now.
Exactly.
I don't know about that. I think the SEC is listening. Don't be talking like that.
I can assure you they are not. All right, let's do some recess here.
It's a nice little bass line. Boom, boom, boom.
You like that? You like that, Spencer? Throw up slides 2 and 3 there. New York City. It's a Thursday. Way back in the day, we used to send our interns into Hoboken to go get us sandwiches. I actually used to live across the street 20 years ago. This is in Hoboken. It's on the other side of the Hudson River to New York City. Thursdays and Saturdays. Show the pictures of inside the joint. Thursdays and Saturdays only. They do a special roast beef with their fresh mozzarella that they make there. This place, if you want a good Italian deli and a great sandwich, go get yourself the roast beef on Thursdays or Saturdays. I highly, highly recommend. Tell them it's your first time there, even if it's not, and they'll give you a little piece of cheese while you wait. Highly recommend that you play the system that way. Spencer from New Jersey.
Wait. Can you go back let's go back to the previous slide. What's this place called again?
Fiore's. It's called Fiore's in Hoboken. It is on Adams between 4th and 5th.
All right, noted.
Thursdays and Saturdays. You pick out your own bread. It's right there on the right. You give it to the nice gentleman with the thick, Italian Hoboken accent. Hoboken, I feel like nobody's from Hoboken. Like everybody who lives there is coming from somewhere else, working in the city. Nobody's from there. But the people that are actually from there have very thick accents, and it's humorous. It makes the sandwich taste better.
Next time I'm in New York City with you, we're taking an Uber side trip over to Hoboken.
So good, dude. So good. They put the gravy on top. Some of my friends like to put roasted peppers. I do not. I'm not against it, but I prefer it, the old-fashioned way. But that's the one little twist if you're into that sort of thing.
Where are you at right now, Jason? You at the mothership?
I'm at the mothership right here. I'm in beautiful 7th Avenue and 34th Street, which is lovely this time of year. The stench is just superb.
Wait, hold on. I'm not done with the sandwich talk. Some of these delis up by where you are right now, or in Hoboken area, instead of lettuce and tomato, they'll do something like sauteed broccoli rabe and roasted red peppers.
Yeah.
And dude, that's some of the best stuff. Nice change of pace.
All right, I might have to go today. I had nothing for recess.
You should go.
Yep.
Hey, I want to shout out in the chat. Who is that? That RBG Jims. He's out there in San Diego spreading the good word about the morning show to all his San Diego trader buddies. Jim, keep doing that. We love it, man. Thank you.
Yeah, appreciate it.
What else we got?
Anyone have anything for recess? Anything else? If not, we can do some questions from the chat because there's a few more, and there's a shit ton of charts we didn't even get to today. So,
what was your favorite monthly chart, Strazza?
Something in tech, probably semis.
And it's your favorite because you think it was just really interesting how strong they were, or it's your favorite because you think they go higher?
It's a big stick. I mean, it's a monster stick. On a relative basis, you got to go back to like the .com bubble to see this kind of outperformance from an incredibly important risk-on group. So
I keep being told that this is just like the .com bubble. And that NVIDIA is like Cisco.
Well, here's the thing. I was looking for evidence of like how extended the current run is, and it looks really extended until you zoom out to like 2001. And then if you keep going and you get to like the mid 90s, God forbid, stuff was wild back then. We're not even close to the types of readings we saw in the mid, late 90s and early 2000s.
Hey, can I know you want to talk about something there, Spencer, but hold on one sec, because you just dropped it in there. All this talk about this being like the .com bubble, I think I risk exposing my age here, but I think I'm the only guy on this panel who traded the .com bubble, and I could tell you, living through that time, this is nothing. We have never seen like what the bubble had. During the bubble, you couldn't go to any party, any family event, anywhere, and everybody was talking to you about some .com stock they were buying. Everybody, school teachers, cab drivers, restaurant managers, everybody was trading .com stocks. The only thing that even remotely came close since then was the cryptocurrency mania, but that was still magnitudes away from what we saw in the .com bubble in the late 90s.
Sean,
maybe it's a uranium bubble. Punch up slide 2 there. Punch up slide 2. Maybe it's a uranium bubble.
Wait, Sean, would you say summer of 22 also comes somewhat close?
So what?
Not at all. Not at all.
Summer of 22.
Sorry, summer of 20, and that whole period, 2021.
Not at all.
No.
I mean,
we were coming up. We were in the middle of a crisis. People were not believing. In bubbles, everybody believes. That's the whole point. Everyone has already bought into it. After COVID, we were still in a crisis. People were not believing. Right. And in that environment was the greatest 52-week period in stock market history, and nobody believed it the entire time. It's when what Sean is saying, at parties, family get-togethers, everybody's talking about the market. It's late to the party. But throw this uranium chart, CCJ. So this is the Exxon Mobil of the uranium space, if you will, up 5% today, looking to break out of this range. And for me, I'm more about horizontal trend lines than I am diagonal ones. But nevertheless, this progression of lower highs has now changed, and we could be potentially breaking out of this. If we're above 32 on the CCJ, which currently are not, we're still below 30. If we can start taking out 32, start taking out those highs from last year, how about that? The return of uranium.
JC, you got a stale chart there, buddy. It's breaking out now as we're speaking. It's trading at 29.50. It's screaming higher this morning.
Yep.
So this giant triangle, whatever you want to call this consolidation at the upper bounds of this base breakout level, really resolving higher right now, like Sean said, if you draw that diagonal downtrend line. I think you could define your risk right here at the year-to-date highs. Call it 29.50, right? And this thing looks far better than anything in the material sector right now, and red hot options activity for going back trailing 5 days now. Options traders been all over this one.
And when you talk about its peers, if you will, in materials, this is almost like a unique sort of space within materials, right? You know what I mean? It doesn't necessarily move with chemicals or with base metals. Like, it's its own sort of animal, which I appreciate.
Yeah, it is. It's like an uncorrelated play, kind of, right?
Should I get pizza for lunch or should I get sushi? What do you think?
Domino's pizza for lunch.
Oh my God, I'd rather ram my head against the wall. Pizza or sushi? I'm in New York.
Prince Street, baby.
I'm so jealous.
I was thinking about Prince Street.
Dirty water hot sauce.
Spencer, I'll meet you in Hoboken.
Yeah, right. I'll meet you there. Hey, all right. That is our show for the day. I want to thank Options Sean McLaughlin, Kimmy Sokoloff, and Jeff Hirsch from the Stock Traders Almanac. Thank you for watching, whether you're watching us on Twitter, whether you're watching us on YouTube. If you are watching on YouTube and you're in the chat and you're commenting and you're asking questions, thank you so much. We appreciate that. That makes the show fun, you being there. If you want to drop us a like, we'd appreciate that as well. We've got CRL Chart Request Live coming up at 1 o'clock today on the channel, so stay tuned for that. And for JC, JC, you're out tomorrow, right?
I'm out tomorrow, guys.
Okay.
So everybody have a great weekend. Get outside, take a walk. Like Perlman says, hold a family member's hand, right? Right. Perlman.
Well, back-to-back long weekends for you, JC. Look at you.
I have 3 kids that are 2 and under, so all my weekends are very, very long.
All right.
Doing something special, a little bit different. We typically do crypto Fridays. Tomorrow's gonna be more like commodities Friday. We're gonna have Ian and Jason Purse. These guys are just commodities monsters. So we're gonna focus on that, and that should be a fun conversation.
All right, let's go, everyone. Happy trading. Good luck out there. We'll see you later.
Adios.
Bye, guys.
I can't take no loss. I don't even know what it costs. I hit the ground, then it go off. Yeah, hit the ground, then it go off.